How exactly does a company break its own revenue records, completely smash Wall Street's earnings expectations, raise its full-year financial guidance, and then immediately watch its stock violently crash in a matter of weeks? That is the exact paradox we're looking at today with Dutch Bros. On August 5, 2026, they reported that second quarter revenue surged an incredible 32.5%. The fundamentals looked absolutely unstoppable. Yet, right after that announcement, the market relentlessly punished the stock. Wall Street is terrified of something hiding just beneath the surface of those record numbers. So today, we need to find out what that is, whether they're actually right, or if the market just handed long-term investors a massive asymmetric mispricing. Look at this number, 22%. That is exactly how much Dutch Bros stock plummeted by late August 2026, sliding from over $65 a share down into the upper $40 range. It traded significantly below its 200-day moving average, entering a heavily oversold, bearish technical state. Now, when a growth stock takes a hit this aggressive, it usually means the growth story is fundamentally broken. But as we unpack the actual underlying business, you are going to see a massive disconnect between the operational reality of this company and the short-term panic pricing of the market. Okay, let's dive into this. Here is the absolute insanity of this setup and the central mystery we're solving today. First, consider the reality of Q2 2026. Total revenues hit $550.9 million, beating consensus estimates by nearly 5%. Adjusted earnings per share came in at 33 cents, crushing expectations by almost 14%. And average unit volumes, which is basically how much revenue a single store generates in a given year, hit a record $2.2 million. Yet, look at the market's ruthless reaction on the right, a 22% sell-off driven entirely by fears of a third quarter deceleration. Wall Street basically looked at a blowout quarter and said, "Yeah, but what have you done for me lately?" To understand if this reaction is actually justified, we first have to understand the real economic engine of this company, because Dutch Bros is not just another coffee shop. The secret weapon driving this whole thing is hiding right in their revenue mix. Their proprietary Blue Rebel energy drinks account for roughly 30% of their total revenue. Now, why does this matter so much? Because legacy coffee shops make all of their money in the morning and are virtually dead by 2 p.m. Dutch Bros uses a highly customizable, cold energy drink platform to capture an entirely different, non-coffee drinking demographic. They literally dominate the afternoon. They aren't just a coffee company. They are capturing market share in both the $50 billion coffee market and the massive energy drink sector simultaneously. And that product strategy builds directly into their competitive moat, which rests on three distinct pillars. First, extreme customization. You don't just order a generic energy drink. You order a unicorn blood or a fire lizard, mixing millions of distinct flavor configurations. This creates a massive subjective switching cost for the consumer. You literally cannot get your exact personalized drink anywhere else. Second is their culture. They hire high-energy broistas who focus on genuine customer connection, which stands in stark contrast to the automated, purely transactional drive-thrus of legacy operators. But the third pillar is absolutely crucial for investors, their internal operator pipeline. They currently have a pool of over 525 candidate operators with an average tenure of 8 years. You can't just buy a Dutch Bros franchise with a big check. You have to work your way up through the company. This ensures that as they scale rapidly, they don't dilute the exact culture that makes them so profitable in the first place. That unique culture scales directly into a frankly massive runway. At the time of their 2021 IPO, management targeted a total addressable market of 4,000 domestic shops. But during their 2025 Investor Day, they significantly upgraded that target to over 7,000 locations. They are currently executing a massive sprint to hit 2,029 system-wide shops by the end of 2029, expanding aggressively out of their Western U.S. stronghold and into the Southwest, Midwest, and the East Coast. And the best part? This physical expansion is now funded entirely through cash flow from operations, utilizing capital-efficient build-to-suit leases that severely limit their upfront corporate cash burn.
So the crucial point here is understanding the underlying unit economics driving that expansion, 45%. That is the cash-on-cash return of a new Dutch Bros location. Think about that. When you build a drive-through only model with zero interior dining room, your build-out cost is remarkably low, about $1.4 million. But because of their massive volume, that $1.4 million box generates $2.2 million in sales. That's an asset turnover ratio of nearly 1.6x. When you factor in their 30% store-level contribution margin, each new unit is just spinning off exceptional cash. They spend a little to build a store, and it makes a massive amount of cash quickly. This is the exact engine justifying their premium valuation multiple. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
But here is where the story hits a brick wall, and where Wall Street completely panicked. In Q2, system-wide same-shop sales grew a very healthy 5.8%, driven by a 4.1% increase in ticket size and actual positive transaction growth of 1.7%. But looking forward to Q3, CFO Josh Gwenzer cautioned that this growth is going to step down sequentially to a range of 4 to 5%. Why? Because they're lapping prior year price hikes, leaving them with less than 1 percentage point of pricing benefit in the back half of the year. The market looked at this single sequential deceleration, assumed the consumer was completely tapped out, and slammed the sell button. But let's actually look at the broader evidence from that exact same August 5th earnings report. Despite guiding for a slight Q3 same-store sales deceleration, management actually upgraded their full-year guidance across the board. Total revenues were revised upward past $2.1 billion, which represents nearly 30% top-line growth. Adjusted EBITDA was bumped up to a midpoint of $387.5 million, and capital expenditures were raised, reflecting their aggressive acquisition of new sites, which we are going to discuss shortly. The reality is the business is fundamentally accelerating on an annual basis, even if the year-over-year quarterly comparisons look just a little bit tougher in the short term.
Now, that isn't to say there are zero challenges. When we dissect the margin pressures from Q2, we definitely see a mixed bag. The good news is they achieved 120 basis points of leverage, meaning they essentially reduced labor costs by 1.2% as a share of revenue, bringing it down to 25.4%. However, they are taking hits on the other side of the ledger. Beverage and food costs rose by 80 basis points, largely due to green coffee commodity inflation and the rollout of their new hot food program. Occupancy costs also ticked up by 50 basis points, reflecting the higher rent growth associated with their rapid build-to-suit expansion strategy. So at the end of the day, store-level gross profit effectively stayed flat year-over-year at 24.2%.
When we pull all these operational vectors together into our qualitative scorecard, Dutch Bros earns a solid blended score of 8.0 out of them. Revenue quality is absolutely exceptional at a 9. 73% of their transactions run through their digital rewards program, creating highly programmatic, habitual purchasing behavior. Management alignment is also strong, with co-founder Travis Boersma controlling 73% of the voting power, ensuring that the long-term vision isn't derailed by short-term proxy fights. The main drag on this score, however, is corporate profitability, which sits at a 6. While store-level economics are incredible, the consolidated corporate GAAP margins remain incredibly thin. Net margin was just under 5% in fiscal 2025.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Now, moving into the valuation framework. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. With that understood, let's look at a 5-year mathematical model ending in 2031 to see exactly what has to happen operationally to justify different valuations. If you want to access the full model with all detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai. Let's start with our base case, which we assign a 50% probability. In this realistic scenario, Dutch Bros successfully tracks toward its 2029 store goal by 2029, achieving an 18% compound annual growth rate to hit $4.8 billion in revenue by 2031. Operationally, we assume EBITDA margins normalize at 19% as corporate leverage finally offsets those commodity and rent inflations, resulting in a 7.5% net income margin. Assuming a moderate 1.5% annual share dilution and applying a slightly matured exit price to earnings multiple of 35x to their projected net income, we arrive at an implied future share price of $67.49. That represents a solid, if unspectacular, 6.2% annualized return from current levels. But let's take a look at the high case, which carries a 30% probability. This assumes rapid, successful geographic density in Eastern markets and perfect execution on their recent real estate acquisitions. Here, digital order ahead optimization, which, by the way, already jumped to 16% of transactions in Q2, drives massive store throughput. Revenue compounds at a blistering 22%, reaching $5.7 billion. Scale benefits emerge, pushing EBITDA margins to 21% as the high-margin Rebel energy drinks sustain true transaction momentum. Because the market historically loves this kind of rapid execution, the stock retains a premium 45x exit PE multiple. If they hit these operational metrics, the implied target price skyrockets to $126.09, which is an annualized return of over 20%.
Of course, to be responsible, we absolutely have to look at the downside. Our low case carries a 20% probability. What actually breaks the thesis here? Well, severe execution and permitting delays stall the footprint expansion. Consumers, squeezed by inflation, pull back on discretionary afternoon energy drinks. Revenue growth slows down to a 12% CAGR, hitting just $3.7 billion by 2031. Prolonged minimum wage inflation and coffee price pressure painfully contract EBITDA margins down to 16%. Most importantly, Wall Street completely strips Dutch Bros of its premium growth valuation, compressing the multiple down to a standard quick-service restaurant PE of 25x. In this bear scenario, the stock price essentially gets cut in half, dropping down to $24.16.
Now, the real insight emerges when we mathematically blend all three of these scenarios together. When we weight the $24 low case, the $67 base case, and the $126 high case by their respective probabilities, we get a probability-weighted expected target price of $76.40. With the market currently pricing the stock near $49.88 following that post-earnings crash, this framework reveals a highly asymmetric return profile. Wall Street is currently pricing Dutch Bros as if the low case is a near certainty, deeply discounting the long-term cash generation of their store pipeline.
But to be totally clear, that low case is a real threat, and it's driven by specific structural risks hiding right under the surface. Recently, Dutch Bros agreed to pay $105 million in bankruptcy court to acquire the leasehold rights for up to 65 shuttered salad-and-go drive-thru locations, mostly in Arizona and Nevada. This is a massive shortcut to site control, but it carries intense execution risk. They have to remodel non-coffee quick-service assets, secure local permitting, and completely overhaul the signage. If those 2027 opening timelines slip, growth stalls. Furthermore, they paid a massive premium, over $2 million per lease for the core locations compared to their standard $1.4 million build-out. Add in the fact that they are sitting on $1.01 billion in off-balance sheet operating lease liabilities, which is essentially hidden future debt, and you can see how heavily leveraged their future capital obligations really are.
Beyond real estate, there are macro and regulatory threats that could structurally impair their margins long-term. Right now, there's an active investigation into Dutch Bros for potential employee misclassification under the Fair Labor Standards Act. If courts determine they improperly classified assistant managers and shift leads as exempt from overtime, the company could face material back pay liabilities and mandatory wage structure overhauls. Combine that with the mandated $20 per hour fast food minimum wage in California and volatile green coffee commodity pricing, and you have a recipe for sustained pressure on that critical corporate SG&A leverage we talked about earlier.
So let's bring this all together. How exactly does a company post record revenues, raise guidance, and still crash 22%? Because Wall Street is obsessively focused on a slight sequential step down in Q3 same-store sales and near-term margin friction. They are ruthlessly pricing in short-term growth normalization. But the reality is, the actual economic engine of this business, the 45% cash-on-cash returns, the highly profitable Rebel energy drink mix, and a self-funded pipeline expanding towards 7,000 stores is fundamentally unbroken. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. The market is pricing in a short-term disaster, but if Dutch Bros executes, this might be the cheapest the stock will ever look. The question is, are you willing to bet against Wall Street's short-term memory? Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.